Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for clicking. On this episode, we're going to be talking about 1% increase by the Bank of Canada, what it means for the economy, and more importantly, your mortgage, variable or fixed, nobody's safe. Stay tuned. We're going to talk about that next. If you're watching this video on the Santo Sessa YouTube real estate channel, once again, thank you for clicking and thank you for all your comments. Please don't forget to hit that share, like, and subscribe button. Don't forget to click that notification bell so you get notified every time we post one of our videos. And if you'd like to book a free consultation with myself or Santo, please feel free to do that in the description box below, and we will make ourselves available to have a conversation about whatever's on your mind. And don't forget to leave all your comments in the comments section below. But right now, back to the video. Why did the Bank of Canada increase its policy rate 1 full percentage point? And what does it mean for the Canadian economy moving forward? Where can Canadians anticipate rate hikes to go? As well as what does it mean for you as a Canadian with a mortgage? Doesn't matter if it's fixed or variable, no one's safe with higher interest rates. We're going to talk a little bit more about the central bank and what it means, and we're going to try to break it down in simple terms. So on July 13th, the Governor, Tiff Macklem, and the Central Bank of Canada looked at its policy rate and increased it 1 full percentage point, the highest we've seen since 1998. And in this monumental move, or nuclear policy rate move, they basically indicated to the markets that they are serious about tackling inflation. It's important to note that not many people predicted, including economists and a lot of the markets, did not anticipate percent. It was a complete shock to a lot of people and to many markets. So we listened to what Governor Tiff Macklem had to say in his press release, as well as looking at some of the data that came out from the July monetary report. And we start to see exactly where their mindsets are with inflation. So obviously, the US data has come out with a 9.1% inflationary number. That's a CPI of 9.1%, very high for the US, as well as that means that Canada, basically very close-knit, inflation for Canada is not going to be too far behind. And many economists are predicting well over 8% for the month of July. And this is important to understand because by increasing the policy rate 1 full percent, or what we call front loading the interest rate, at least signaled to Canadians, hey, we are serious about tackling inflation. And why is that important is because they need to change the sentiment in the Canadian mindset. So a few important concepts that were discussed in the release was what's called wage spiraling. So wage spiraling is where you have a labor market with the positions that need to be filled, but nobody to fill these positions. And in order for companies to bring on these workers or these employees, they need to pay them more. And by paying them more and increasing the wage demand, it becomes a self-fulfilling loop. Now, that is generally a good thing when you increase wages, but it doesn't work when you're trying to tackle inflation. The other problem that arose that we hear from the central banks is the cost of goods and services, because if the purveyor of, let's say, a product has to pay 10% more for that product, that cost is generally passed on to the consumer, and the consumer pays, and it continues to go on. Now, we also had this reoccurring problem that we've talked about several times on this channel, where the Canadian sentiment about inflation being entrenched in the mindsets of Canadians is a problem, because if Canadians look at spending today versus tomorrow, obviously by spending today, they're going to save money because they believe that the cost of that product will be more expensive tomorrow. And this is exactly what the central bank wants to avoid. We need to let Canadians know that we have inflation under control, and also to take the excess demand and spending out of the system. Many Canadians who in the last few years have basically taken on an extreme amount of debt are basically now faced at a crossroads, and this is going to be a major problem moving forward. So when we look at what the knock effects are on higher interest rates, obviously we are aware that it will increase the cost to borrow money. But by increasing interest rates, you have this impact on the housing market. And here in Canada, housing makes up at least 10%, I would argue more, of GDP than in the US, where it's 5%. So it is a significant component. So when you look at GDP and you look at production, by looking at the interest rates going up, house prices will tend to fall or come back down to normal. And by doing that, you're allowing, or stopping, I should say, Canadians from using their homes as ATM machines, where they are not able to borrow as much money as they were just a few months ago because the house values come down. And even if you're able to access that equity, the amount of money that you're going to be paying to borrow those funds will be high, and that's going to be expensive for Canadians. Now, obviously, when we look at what's called real negative interest rates, where we see inflation at, let's say, 8%, and the policy rates at 2.5%, obviously there's still a significant range there, but they are trying to bridge that gap or close that gap percent. Because remember, 2 to 3% is where the central bank wants inflation to be. And now that we've increased policy rates 1 full percentage point, we are now in what's called the neutral range for the Bank of Canada. So what is the neutral range? The neutral range is basically where there's little expansion and little contraction in the economy. The soft landing that they're talking about, basically avoiding a recession. By keeping policy rate within that 2 to 3% range, they believe that they can avoid a recession and soft land this inflationary problem. Many economists, however, are predicting that the central bank will overreach that point and maybe go over the 3% mark to 3.5%, even 4%. But generally what happens, and we look at some charts and some data, we start to see that, as central banks increase their policy rates, it's followed by a decrease, because generally central banks will overreach. They will go too high, too fast, and then have to pull back. Obviously, history doesn't always repeat itself, but generally it's a good indicator to see how things react. Now, it's important to look at the central bank's data and see exactly how they've treated policy rates in the past. And remembering that inflationary data is backwards looking, this 1% increase is forward looking. It's hoping to tackle inflation more aggressively. Now, where does it leave us with rates, right? This is very important. Depending on what the data looks like, we are anticipating further increases potentially by the central bank on September 7th and maybe again in November. So these are things that we need to pay attention to for Canadians with mortgages. Where does it leave us in 2022, 2023, and in 2024? One important side note is that over the last little while, obviously the Bank of Canada's mindset or their forecasting and projection has changed significantly over where they saw interest rates and policy and inflation just a few months ago. We went from earlier on in the pandemic to interest rates will stay relatively low until 2023. And then we saw that, hey, inflation is basically transitory to, hey, inflation is probably going to be here for a little bit longer than we thought. So obviously we've seen the Bank of Canada, renege and sort of reshift their focus and see exactly where inflation is going. Now, when we look at where things are going, obviously it's important to understand where Canadians are headed when it comes to their mortgages and what it means for them as a mortgage holder. So obviously there's 3 types of mortgages that are readily available to Canadians, and that is your fixed rate mortgage, your traditional 5-year. Then there's what's called your adjustable rate mortgage, where your mortgage payments change when the Bank of Canada increases its policy rate, and in turn your lender increases its prime lending rate. And then you have what's called a static payment variable or a fixed payment variable mortgage. Now, all these products are not the same and each have their benefits and their downfalls. It's important to understand. When you look at a fixed rate mortgage right now, you are looking at a product that is based on, let's say, the bond market, the 5-year treasury, and where things are headed right now. Canadians who are approaching renewal in the next few months are and should be preparing for higher interest rates on that mortgage. Now, many Canadians who believe that they're protected in a fixed rate mortgage are generally correct. However, when that mortgage comes to renewal and interest rates go up, you do need to be prepared for that. And our advice to Canadians with fixed rate mortgages right now is to look at where rates are headed, or basically anticipate future rate hikes, estimate their payments at those future amounts in comparison to theirs at their current payment now, and put that money aside, put some of that difference aside. Whether you put it into investments, whether you put it into a savings account, it's important to hedge your bet on the fact that interest rates could potentially be going up in the next little while. And those who are protected will fare much better in the future and weather those storms better if interest rates do end up going up for those mortgages. Now, let's talk a little bit about the variable rate products. And that is something that we talked about in other episodes regarding the trigger rate and variable rate products. So obviously, to recap, so if you have a variable rate mortgage where your payments are static and do not change, it's important to understand that you're not 100% safe at the current moment, because with this 1% increase, it could bring you that much closer to the trigger rate. Now, obviously, the trigger rate will differ from lender to lender. Depending on that rate, it could change how and when that trigger rate hits. And when that trigger rate hits, many Canadians may be in for a big shock. And that is important to understand, because if you were maybe paying 2% and your payments are based at that 2% mark, and your trigger rate, let's say, is 4.5%, and you hit that trigger rate, your mortgage will basically need to readjust to that higher rate. Some banks will renegotiate that mortgage, whether that means increasing your payments or potentially increasing your amortization, or have the ability to pay off the mortgage and maybe switch to a different lender. So understanding what that trigger rate is and what it means for you and your mortgage is important. And what you can do to basically protect yourself is reach out to your lender and increase your payments. The lender won't do it for you. You need to reach out to your lender if you have a static payment on a variable product. Keep that in mind. Now, one of the better products out of all the variables will obviously be, by default, the adjustable rate mortgage. This is the product that I'm actually with, and I do like this product, even though, yes, we are taking the brunt of the hit when the policy rate increases. And yes, it does increase and change my payments, but I am basically still ensuring that my amortization does not change. So if I got a 20-year amortization, and yes, interest rates have gone up, I'm paying that interest up front and basically continuing on the path to ensure that my mortgage amortization does not change, and I do not get triggered, and I do not have a really big shock in the future when it comes to my payments. Now, obviously, yes, it's upfront, pay now or pay later, but it's very important in this rising interest rate environment to understand your products better. And no matter who you are or what product you have, even if you don't have a mortgage, during these times, it is very important to avoid as much debt as possible. So we'll leave the video here. Obviously, if you have any questions about your mortgage, a mortgage renewal coming up, and you want to reach out to us here at InTouch Mortgage Solutions, we'd be more than happy to help. If you find the content that we produce very important and valuable, please don't forget to hit the share, like, and subscribe button. It really helps us out, and we can get this content out to many Canadians across the country and help educate them when it comes to mortgages and what to be prepared for. So we'll leave the video here. I hope everyone has a great weekend, a great Friday. Once again, thank you for clicking, and have a great weekend.